So, to round out the presentation before we get into questions and answers for Marty, Ryan, and myself, this is a great chart. This basically shows you during any year the declines versus calendar year returns. The solid gray bar is the the returns for each year by year. We hate years like 2008, but we know it comes with the territory. Thank God, as you can see from this chart, there's not as many as these negative years as there are positive years. And we always say, we have a saying in the office, we're investing for the long term. We're looking at the stock market for the way it should be looked at. We're not investing money to lose money. Not that we like when the stock market goes down, but we know the stock market goes down. And what's nice about this chart, and you can see all of these red lines. In any given year, the market could be down this percentage point. So last year, 2014, we ended up at about 11%, but we were down at 7%, negative 7% at one point. 2013, we ended up 32% with dividends. We were down 6% at one point. 2012, we ended up, the S&P with dividends was up 16%, but there was a point when we were down 10%. You get the picture. In any given year, take the calendar year return. At some point during the year, it's normal to have declines. Now, here we are starting off 2015, and we're stumbling. The markets are kind of flat year to date. The headlines aren't great, aside from the emotional headlines of the acts of terrorism and other barbaric acts around the world. The global headlines with oil, the recession in Japan. We have a slowdown, almost stagnancy in the Eurozone. China is slowing down. We're not used to all of this. That's what Marty, Ryan, and I call in our business noise. We listen to the noise. We take away from it what we want to, but we're not going to panic. And we don't panic when it comes to investing because we're pretty confident in the portfolios, what we're invested in, and why we're invested. We're always invested thinking ahead. Can't change the past. So when you see negative returns, that comes with the territory. This is a chart, and we've seen this chart over and over and over again. 1950 to 2014. You know, your average return in stocks is 10.8%. Your average return in bonds, 6.2%. A 50-50 portfolio, 9%. Well, we know, especially over the last 30 years with that story that we told on bonds, it was easy to make money in bonds. But when you take and you look, stocks, any given year, down 37%, which just happened to be in our recent memory, 2008, and we hope we don't have those memories anytime too soon. But you could have a year where you're up 51%. Bonds, you can be down in any given year as much as 8%, up 43%. And with a blended portfolio 50-50, down 15%, up 32%. That's in any one given year. Now, any client of ours that says they need money in the next year or two or three, well, we're not going to have them fully invested because we're going to protect. We don't want a 2008 to come. Somebody, a parent saving money for their child's education, and all of a sudden their $100,000 college fund drops to $60,000. We don't want that to happen. So we're going to be very conservative, anybody who needs money over the next year, 2, 3 years. So when you look at one-year investments, this is a good chart because this is a gut check. This tells you what can you accept. Can you accept being down 37%? And we worked hard back in 2008, 2009 on your behalf, and they weren't fun years. I had a 25th wedding anniversary on February 25th, a week and a half before the market bottomed out, and I had to tell my wife that I had to cancel the anniversary because I felt I needed to be in the office. Things weren't pretty back then. Then all of a sudden we hit the low on March 9, 2009, and things have gone up since then. But it was my job to make sure I worked on your behalf and be there for you. And I'll never forget the one day when the market dropped 800, 900 points. It was a Monday, and thank God with technology, I have about 82% of our clients' emails, and I sent out a blanket blind email at 4:05 that day, and that was not a pretty day. I remember it vividly. I said, I will be here this evening if you want to talk, just to let clients know, because this is when our value comes in, is to make sure we're there for our clients during times of uncertainty. And I had probably a dozen phone calls from around the country. Most of the calls were people worried about me. I said, well, I'm reaching out to you because I'm worried about you and how you feel. I had some clients call that said, hey, God, I'd like to invest some money. So that's what we try to do. But the point we're going to make with this slide is, in any one given year, you could have a good year or a bad year. And we always point out the bad years because during the good years, everybody feels good. During the bad years, you say, geez, why am I invested? If we did our job right, you're invested for the right reasons and you understand the risk that comes with that. And you know that this is going to be part of it. Now let's look at a 5-year rolling picture. So here you go from being down 37% in stocks, being down 2% in a 5-year rolling, going back from 1950 through current times. That's not bad. Over 5 years, can you accept being down 2%? Most people could. Up 28% over a 5-year rolling time period. Bonds down 2% as well, up 23%. A 50-50 portfolio, up 1%, up 21%. Well, that looks a lot better, a whole lot better than here. And then over 10-year rolling periods, down 1% in stocks, up 19% on average. Over a 10-year rolling period, 1% return positive in bonds to 16% in your best 10-year rolling period. In a 50-50 portfolio, your worst 10-year holding period is up 2%, your best up 17%. Not bad. Then when you go to 20 years, your worst 20-year holding period down, or I'm sorry, up 6% in stocks, your best up 18% in bonds, still 1%. You can't, you can't get away from that. So your best 20-year rolling period up 1% in bonds to your worst is up 1%, your best is up 12%, and in a 50-50 portfolio up 5% in your worst year, up 14%. That's a whole lot better than this. So when we have times like this, we always point out to you, well, geez, you said you were going to retire in 10 years, right? Well, yeah, nothing's changed there. Or maybe you are retired, and we always say, you may be retired, but you don't plan on dying. And if you're married, there's a good chance that one or the two of you are going to live into your 80s and 90s. And this is why the longer time periods is what we try to point out, guaranteeing you in any one given year, it could be ugly. Let's not be average. Basically, if you look at a traditional portfolio, 55% the S&P 500, 30% the EFA, 15%, 15% the EFA, 30% the bond aggregate. Your return is 8.02%. This is 1994 through 2013, so it's like a 20-year chart. Standard deviation 10.64. That's pretty good diversification. This is more like what we do. We have a more diversified portfolio than a traditional portfolio, and you can see you have more sectors in the portfolio. Your average return 7.95, almost where you were at 8.02, but you have less risk, and that's what we try to pay attention to. We try to manage that risk. We always want you to make money, but we're managing that risk on your behalf, and there will be times when we add risk to the portfolio, and there's times when we take risk off the plate. Back in 2011, when Greece started going through some problems and the USA lost its AAA credit rating, and we just had so much uncertainty, elections and everything else, we felt we wanted to take some risk off the table and kind of get through that. We didn't panic, we didn't market time, we didn't sell out of the markets, we just wanted to take some risk off. That was a time when I wanted dividends, and I wanted to have companies that I felt comfortable with. So I added Johnson & Johnson, Procter & Gamble, GE to get those 3% and 4% dividends at that time. And I felt comfortable with that. We also added Bank of America because we liked it. We added some Apple because we liked it. And we did that for all the right reasons. We just wanted to kind of control the risk as best we could. So we'll take risk off the table, and then at the end of that year, we put risk back on the table because we felt comfortable with everything. And it actually turned out it worked in our favor and in your favor because it was the right move to make. So we'll manage that risk. You'll see us buy and sell. REITs, we were loaded up in REITs in 2009, the summer. I loved REITs. I was getting a 5–6% dividend in the REITs. And we bought REITs for all of our clients, and our core position is about 4%. Well, from 2009 to last summer, when interest rates were bottoming out, we felt that we got a lot out of that REIT exposure. So we took some risk off the table. We pared back some clients that were with us in 2009, their REIT exposure went from 4% as a core position, 6, 8, 10, 12%. So we pared that back and we sold off and brought our clients back to that core 4%. And this is what we do all the time. We're always looking at where we're at, where you're at, and what we can do to manage that risk and hopefully capture the return that we're looking to capture without taking any additional risk than we need. This slide is basically performance and average valuation. You'll have on any given time, the gray line here is returns before markets past average valuation. So average valuation, you'll have the returns, and then the light blue line is returns to peak price after average valuation. And as you can see, there's times when there's a lot of added returns. So when you look in the 90 here, you had almost 263% return, 180 from what we were expecting, 83 from the added price. Right now, we're not sure what to expect, but we're pretty optimistic going back to what we said a couple times tonight, that the stock market has room to grow. We're invested for that growth. We feel comfortable knowing that there's going to be volatility as we've experienced since really the fall. That comes with the territory, but the long and short of it is we think there's more room for the stock market to grow, and we're favoring stocks as an asset class in the right way. And this is one of our favorite charts. This is all the sectors. So last year, right here, last year, REITs were up 28%, the S&P 13.7%, the bond index 6%, a well-diversified portfolio of 5.2%, the Russell 2000, which are small caps, 4.9%, cash, 0%. Market neutral funds down 0.5%, emerging markets down almost 2%, developed Europe down almost 4.5%, and commodities down 17%. What we want you to look at is all those great colors. But more importantly, we want you to look at those colors and think about how there's not a pattern where the same color stands out all the time. And we try not to invest in last year's winners. So last year, I told you, we sold out some REITs. REITs were really good to us. We bought here in 2009. We had a great ride. It was one of our top performing investments. And we took some money off the table in REITs. We don't feel bad about that. REITs are still doing well. It's still a core position in our portfolio. We're getting almost 4% dividend yield, which is a whole lot better than 0% in cash and 1.8% to tie your money up in a 10-year Treasury note. And this is how we invest your money. But the point that we want to make with this slide is having a diversified portfolio. This is this black line. You're going to do pretty good, steady Eddie all along the way, and that's how we try to invest your money for you. And dividends do matter. You know, when you go back over time, like last year, the S&P was up 11% with dividends almost 13.7%. Every year, you have capital appreciation or losses, But when you have capital appreciation, the markets are up, and then there's dividends added to that for your total return. A lot of times people say, well, how much interest can I get? I said, we don't want you to think about interest. We want you to think about total return. Capital appreciation, where you make money on your investment. In some years you're going to lose money. But capital appreciation, let's say for most years, plus dividends, plus any interest you earn, equals your total return. So your interest may only be, in this environment, 1%, 2%. But your total return may be 10, 12, 15%, depending on how your portfolio has looked over the last several years. That's what we want our clients to concentrate on, is total return, not so much just interest. But dividends do matter, and in all of our investments, we pay attention to dividends, and we're happy with the mix that we have right now. So, to summarize, the secular bull market, we think, is in place. We think the stock market has a way to go. Volatility will continue. We know that. We guarantee that. And we will buy into the weaknesses and sell into the strength. Sometimes we may be a little early, like with energy, but our long-term outlook is pretty optimistic. International, we have valuations that are appealing, but they need a catalyst for growth. One of the best catalysts, as Marty pointed out, was that them buying back some bonds like we did. The market tripled. One of the catalysts was that bond buying program. We were doing it at $85 billion a month. They're doing it at $60 billion a month. They're just starting that. Another reason why we think international investments may do well, and you may see us add to them. You have interest rates will rise when we don't know. And this, as Ryan pointed out, diversification for the income portion of your portfolio is real important. We're not going to get greedy, and we don't want to tie. We haven't bought an individual bond in a long time because we don't want to tie up our clients' monies long term with these low interest rates. But there will be a time. If interest rates go back to the norm, 4, 5, 6, 7, 8%, wherever that is, you may see us buy long-term bonds and lock in on that interest that we are guaranteed for whatever it be, 5, 10, 15 years, depending on the length of the bond. We will buy bonds when interest rates go up. We're not buying them now. And each and every client, Marty, Ryan, and I say it all the time, are you still comfortable with the amount of risk that you're taking? And if you're not, one of us so we can talk to you and make sure that you understand the risk that you're taking. You know the good and the bad, but most importantly that you're able to sleep at night. I'm going to stop there and see if there's any questions for Marty, Ryan, or I.